This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone, live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. It is Bloomberg Businessweek Daily on this Thursday, July 17th, 2025. I'm Tim Stenovec, along with Bloomberg News equities reporter Norah Mulinda. She is in for Carol Massar this afternoon. And Norah, if you look at today's trade, quite a different tone than yesterday when, I don't know, everybody was freaking out about what would happen with Fed Chair Jay Powell. Now it seems like everybody's confident, based on some economic data, that things are pretty awesome right now.
I mean, can we say risk on mood? I mean,
I think that's fair to say.
Info technology, we're seeing tech stocks as the best performing sector right now in the S&P 500. Definitely a different tone that we're seeing right now as we're parsing through some of that economic data that we'll be talking about today. So looks like we're pointing up.
All right, we're going to hear from Molly Smith of Bloomberg News. She's the economics editor in just a minute. Charlie's going to have more on today's trade and top business stories in just a minute too, but also on the Fed. We're going to be hearing from former vice chair for supervision of the Fed, Randall Quarles, is going to be joining us in just a few minutes from Victor, Idaho.
And we're getting Netflix earnings after the bell. Expectations are high after the stock has nearly doubled over the last year. What to expect with an analyst who has an outperform rating on the stock.
All that and more coming up over the next hour right here on Bloomberg Businessweek Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Hi, thank you very much. We're looking at records right now. Norah, by the way, mentioned Netflix. That stock up now by 1.5%. We're going to be all over those numbers after the close of trading. But the Dow, the S&P, NASDAQ, all pushing higher. Right now, we have got a record on the S&P 500 index, a record on NASDAQ, and economically sensitive shares outperforming after better than estimated retail sales and a drop in jobless claims. S&P right now up 31. That is a gain of 0.5%. We've got the Dow up 0.4, up 196. NASDAQ up 174, up by about 0.8%. Broad-based rally. The Russell 2000 index of small cap shares pushing higher now by 1.1%. Your 10-year 4.46%. The 2-year 3.91%. The 30-year 5.01%. Spot gold lower a little change, down $10 the ounce to 33.37, down 0.3%. West Texas Intermediate crude up 1.4%, 67.29 a barrel on WTI. Earnings news fast and furious. This morning we heard, or last night we heard from United Airlines Holdings. United says the second half of the year has become more predictable and suggests it may be able to beat its earnings targets after customers resume booking flights. American United up by 2.8%, American up 2%, Delta higher now by 1.4%. So again, recapping, key takeaway right now, we're looking at records on the S&P up 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, signs that the U.S. economy is holding up, just lifting stocks this afternoon, as we heard from Charlie. This coming just a day after speculation about the Fed chair really rattled markets. Better than estimated retail sales and a drop in jobless claims pointed to economic resilience, driving the S&P 500 toward fresh all-time highs. Let's bring in Molly Smith. She's Bloomberg News economics editor. She joins us here in the Bloomberg Businessweek studio. I want to start with retail sales because a big rebound in June, a broad advance, 10 out of 13 categories posted an increase. Does this answer all questions about the health of the U.S. consumer? Are we all good?
God, I wish it was that easy, Tim.
It's not?
I wouldn't be here if it were that easy.
All right, explain.
It was, so I like to caveat by saying that like retail sales is, I would say, like a relatively narrow look at consumer spending, that this is a report that mostly captures just spending on goods, like physical stuff. But that's really just, that's a third of overall consumer spending in our economy.
I think this is a really important point. The consumer powers the economy, but services are what they spend their money on.
Bingo.
Okay.
Yes. So not to say that a third of consumer spending is nothing, but it is not the majority of where consumer spending is really directed at. So that's one thing. Second thing, these are not inflation adjusted. So when you see these increases, you can kind of do a little bit of the math, since we did just get the CPI to see where prices were rising or not. But generally, if you see a number that's up, it could be up because prices are up or because actual spending activity is up, or both. So in this case, there's probably a bit of a mix of that. And either way, though, the takeaway from economists was definitely positive that, we just had 2 months of declines in retail sales coming into June. So to see a rebound, especially of this magnitude, was definitely reassuring in some ways, that maybe tariffs are not totally sapping consumer demand, at least as of yet.
But not the end all be all here, which you've clearly spelled out for us here. What were some of the highlights that you saw in this print?
I don't know if I would call it a highlight so much as a surprise that that motor vehicle sales were up as much as they were, especially because we saw the administrative data from Ward's Automotive Groups showed that car sales dropped again in June, and the CPI report showed that car prices were down. So that, to me, would spell an overall negative for car sales. Economists are saying probably a seasonal adjustment issue, because I'm not really sure how else you would get a positive number out of that.
But there was also this pull forward in the earlier part of the year because consumers were very worried about what tariffs would do to automobiles. Is that part of this equation at all? Is that why it's surprising too?
I think that there's probably still, there's been so many, obviously, as we know, whiplash with tariffs. Are they on? Are they not? Is it delayed? What date? So I think, there was a bit of a pullback in June when we had, put to rest the idea of 100+% tariffs on China. That was like a pact that was reached in early May, and that we've had a bit of this pause until now we had this announcement in the past week that the really more significant tariffs are going to kick in next month. At least that's the plan right now. So who knows? We could be going through another one of those lulls right now with the tariff talk that could be boosting spending and sentiment in the meantime.
Well, let's talk about the job market right now. Of course, we got that weekly print that we always get, which is jobless claims data that came out today. We saw that the estimates were 233,000, but it actually came in at 221,000. So a slight miss here. But what are you really seeing when we think about the broader economy as it relates to jobless claims?
Well, it's a good thing when we see a miss on jobless claims. Just want to point that out. That means fewer people are filing for unemployment. So that's a good thing.
Applause.
Assuming that we're in the camp of not wanting people to lose their jobs. So that's good. And at that level of overall claims of where the initial ones have been coming in this 220,000 area, that's very much in line with the pre-COVID economy and would suggest a pretty solid labor market overall. Granted, where more of the concern is happening is in continuing claims. So these are people who are continually receiving unemployment benefits, whereas the other number is just new filers. So the continuing claims number has kind of been flirting with around that 2 million number for a while now, kind of up around the highest levels since the end of 2021. That one has definitely been trending in a worse direction.
So for a while, it used to be bad news is good news. Where do we sit now? What do we say?
Oh, gosh. I want to say that good news is good news. I think, a lot of it is because you're thinking from the perspective of what happens to Fed rates, right?
Absolutely.
And so, right now, all of this data is telling you that the economy is solid, and that this is also supporting why we're not expecting to see rate cuts in July, at least July for now. Who knows? September still seems to be a wild card.
Okay, so on this, I just want to end with you on the Fed and play some sound from one of the Kevins who is vying to be the next chair of the Fed. Kevin Warsh, former Fed governor, was on CNBC earlier today.
I think the president's language is this could be a golden age. And frankly, I think they all could be right. Good policies could advance this U.S. economy, what we call AI. In a couple of years, we'll just call business. And AI is going to make almost everything cost less. And the U.S. can be a big winner. If I were the president, what I'd be worried about is a central bank that doesn't see any of that. A central bank that is stuck with models from 1978, governance from a prior period, and don't recognize we could be at the front end of a productivity boom. And if I were the president, I'd be worried that they might not see it.
Kevin Warsh, former Fed governor, on CNBC earlier today. Molly, I want to ask you about this idea that a central bank with this dual mandate, in Kevin Warsh's view, might be stuck on old models and old priorities. What's your view on this?
I still think the priority for the Fed is definitely the dual mandate, as you said. So that's ensuring price stability and maximum employment. And I think those are still good goals to have, no matter if you're in 1970 or if you're in 2025. There are a lot of central banks that don't have both of those. They just have an inflation mandate or an employment mandate, but not both. So I think that, and that's also something that for us comes from Congress. That's not the Fed's own idea. This is a mandate from Congress as to what they're meant to achieve here. That said, I mean, yeah, the economy is rapidly evolving. AI certainly has a lot of promises, but I don't think that's really had any widespread impact yet in terms of like taking out jobs that were, at a really widespread level here. I think it's just so far been like pretty concentrated, and like we haven't yet seen all of that. And of course, when those things are going to be happening a bit more notably, yes, the Fed wants to be acting forward looking, but like you can't also be like, acting in advance of like, if this is still perhaps years or decades away from now, who knows?
All right, good place to end it. Molly Smith, Bloomberg News economics editor, joining us here in the Bloomberg Businessweek studio. We mentioned stocks are moving higher. One of the stocks getting a nice boost today is PepsiCo. Shares popping higher, as much as 7.4% earlier in the session. Right now, they're up 6.9%. The company reported organic sales growth of 2.1% in the second quarter. It outpaced the average analyst estimate. Earnings per share was $2.12, also higher than market expectations. The company maintained its annual outlook. Let's bring in Kenneth Shea, senior analyst for consumer products for Bloomberg Intelligence. He joins us from New Jersey this afternoon. I want to remind everyone, Ken, Pepsi owns Gatorade, Lipton, Quaker, Frito-Lay, and a lot more. The company is working to overcome, though, a trend toward healthier, less processed foods, as well as lower cost private label options. Is it succeeding?
Yeah, hi, Tim. I think it's making progress. Sure. When you say succeeding, it's never-ending battle to keep up with consumer shifts in taste. But PepsiCo has been monitoring the consumer for many, many years. It convinced the street, I believe, on the call today that it's making positive strides in keeping in tune with what you're suggesting here. First of all, it's just coming off the May acquisition of Poppi, a company that makes prebiotic sodas and so on in sync. It is looking to increase, more avocado and olive oils in its mix. It made the case that later this year, it's going to relaunch its huge Tostino and Lay's platforms with healthier ingredients. And I think what really excited investors also is that later this year, it's going to expand its line of protein drinks, which are very much in sync with the GLP-1 drug user need to replenish with protein. So all the above are signs that companies very much in tune to where the consumer's going. I think that's behind a little bit of the optimism in the share price today.
Hey, Kenneth, what does this all do to margins, though?
Well, today, the company beat on the margin line, and I think that was another positive. Sentiment was pretty low with PepsiCo. The first quarter, was not a good one. I think they lowered guidance, and today, they beat low expectations. And in that is margins. Now, the company's always been, stressing productivity. And I think what gave more credence today in that call is that when they realigned their business segments earlier this year, that is, they're combining the Frito-Lay franchise with Quaker, and they made the case that, you had two standalone big entities and with a lot of redundancies, and they see opportunities to reduce those and to take those savings and to reinvest in some of the initiatives that I mentioned before. So I think expectations for margins going forward are actually probably going to be, raised going forward.
Pepsi also said that it was removing synthetic dyes from its U.S. School foods by the start of the upcoming school year. It plans to introduce what it calls, quote, extensions of Cheetos and Doritos with no artificial colors or flavors. I look forward to seeing Cheetos with no artificial colors. I wonder what those will look like.
Oh, so curious.
But what's the idea? What are extensions here? What does it mean by extensions? They're not going to change that core brand that we know. They're going to launch different versions of these iconic brands.
Yeah, that's right. I guess they're still in the late innings of the increased spice, the heat, Lay's and Cheetos. It seems like consumers can't get enough of the, spicy and heat products, but they experiment with new flavors. There was the promotion they had a few years ago about consumers writing in about the different flavors for Lay's, and that was a big hit. I would suspect that part of the launch we're going to see later this year may include something like that, and that gives them an opportunity to have some fun with these brands and increase consumer engagement with new flavors.
Okay, so now's the time we want to talk to you about what I think a lot of people are familiar with as Mexican Coke, the idea of Coca-Cola not being made with high fructose high fructose corn syrup, but rather real sugar instead. The president announced yesterday that Coke has agreed to use cane sugar in Coke beverages. Coke says, hey, stay tuned. You're skeptical, though, about a full-fledged change from high fructose corn syrup to sugar. Why is that?
It really comes down to economics. They moved over to HS, high fructose corn syrup, years ago for cost savings. They made the case that from a, sugar standpoint, it's basically the chemical equivalent of sugar, but it can be delivered much more economically. You got to remember, corn is probably the most heavily subsidized commodity in America. And as such, they can obtain corn very plentiful. A lot of suppliers of corn syrup in America, and they can formulate their product very economically compared to sugar. I hear that corn syrup also, the shelf life is longer. So for a lot of reasons, the company would be very reluctant to move away from what it's doing right now. The other quick thing I would point out is that Coca-Cola, most of its business is supplying concentrates to its affiliated and independent bottlers who make the finished product. If you switch from high fructose corn syrup to sugar, you're going to not only bear costs at Coke, but to all its bottlers. I find it highly unlikely that Coke would want to incur that and the wrath of all its bottlers in making such a switch. It'll be interesting on Tuesday when they have their second quarter call, and I'm sure they're going to elaborate more on the details here that everyone's looking for. My guess is that they may expand some of the sugar products, cane sugar and beet sugar, whatever products in the U.S. to complement the high fructose corn syrup versions. But I really doubt they're going to just, switch all of it, away from corn.
So, I think it'd be really interesting, especially when you talk about these alternatives to just doing a complete switch. But as people are having discussions, what does it seem that the impact would be if there were a complete switch? Just how expensive would that be for the company?
Well, that's tough to say. Like I said, it would not be on Coca-Cola. It would also be all the bottlers. And that, it's a good question. I don't know the details. And I would say stay tuned to Tuesday to find that level of detail. Like I said, I'm very skeptical that this is going to be a reality, though.
Was there anything on Pepsi's call that sort of alluded to Robert F. Kennedy Jr. and the president yesterday making this call with regard to Coca-Cola? Was there any talk of them removing high fructose corn syrup or supplementing products with real sugar?
They alluded that they were open to, add more complement sugar to their portfolio. But I don't think these companies would be, open to a complete switch. And I think that's kind of what they conveyed today.
We only have 30 seconds, but you said they wouldn't want, Coke, for example, wouldn't want to face the wrath of its bottlers. But in a sense, they might have to face the wrath of the president.
Yeah, they're going to have to thread this needle. Stay tuned to Tuesday. The drama's building.
Okay.
I wish I had all the answers on this one.
Tuesday it is. I hope you're in the office or at home next week following the Coca-Cola earnings, because we're certainly going to have you back, Ken, to weigh in on those. That's Kenneth Shea, Senior Analyst for Consumer Products for Bloomberg Intelligence, joining us from New Jersey. Shares of Archer Daniels Midland, interestingly enough, a supplier of corn syrup, down 1.2% as we speak, off the worst levels of the day. Coming up next on Bloomberg Businessweek Daily, we got Netflix earnings. After the bell, a preview from Wedbush Securities. That's next on Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P and the NASDAQ Composite Index trading at records right now. The Dow, the S&P, NASDAQ all higher. S&P right now up 31. That's a gain of 0.5%. The S&P at 62.95. Economically sensitive shares outperforming after better than estimated retail sales and a drop in jobless claims. The Dow up 235, now up 0.5%. NASDAQ up 157, up by 0.8%. 10-year 4.46%, the 2-year 3.91%, the 30-year 5.01%. Spot gold down 0.3%, the precious metal at $33.35 the ounce. West Texas Intermediate crude up 1.5%, 67.36 on WTI. Uber teaming up with electric vehicle maker Lucid Group and self-driving tech startup Nuro to launch a Robotaxi fleet. Uber shares down 0.3%, rival Lyft down 0.8%, Lucid surging 37.5%. White House doctors have diagnosed President Trump with chronic venous insufficiency, though the physicians say the president remains in excellent health. That word from the White House. 79-year-old Trump underwent an exam after recent photos showed the president with swollen ankles and a bruised hand. Coming up after the close of trading today, we will be hearing from Netflix. Netflix shares they're gaining now by 1.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks also for the setup, Charlie Pellet. Appreciate it. As Charlie mentioned, Netflix is set to report after the bell. Expectations, they are high. Netflix's stock price has close to doubled over the past year. It's added about $250 billion in market cap. It's lifted Netflix's forward price-to-earnings ratio to 43 times. That's well above the NASDAQ 100's 27 times. Alicia Reese is Senior Vice President, Equity Research. She covers media and entertainment at Wedbush Securities. She joins us from Oregon this afternoon. Alicia, welcome. Netflix no longer provides subscriber additions or guidance around that, which for years, this was the metric that moved the stock when the company reported results. But you and the Wedbush team did a survey of consumers to get a preview and really have an idea of where it stands in the U.S. What did you find?
We found that there was quite a few people that came back to the service that had churned out over the last quarter, and the retention was shockingly strong for the second quarter. But the piece that surprised us the most was that even though there is the recent price increase on all the tiers and pretty significant on the premium tier stickiness and return to the premium tier from perhaps ad tier was quite high. And so what we'll see, I think, in the quarter is not just good subscriber numbers, but really strong ARM. And while they don't give that information anymore specifically, I think they can speak to it generally, and their revenue certainly will show that. And in addition to that, that should translate to really good leverage, great earnings, and free cash flow.
One thing that might surprise people who haven't tried to quit Netflix but have tried to quit cable is that Netflix is really easy to quit, and it's also really easy to subscribe to. And that's something that the company has really tried to make a point of doing in its history. What is it specifically that brought consumers back that churned out over the last year or so?
Yeah, well, what we're seeing primarily is that the people who are churning out and coming back, they're doing so for a relatively short period of time, and they'll come back for the content. Really, over the last year, not including the second quarter, Netflix was plagued with the SAG-AFTRA strikes, the fallout from that, as were the movie theaters and all the studios. Really, there just wasn't a ton of content to go around as productions had been stalled for a while. Now we're seeing in the second quarter, and we should see through the rest of the year and throughout the following year, really good content quality, content volume, and Netflix has so much cash to spend on that. $18 billion is earmarking for the year, likely going even higher next year. They just have plenty to spend on the best content, and that keeps people on the service.
Alicia, you mentioned the quality content. What type of content are they coming back for? When we think about consumers, everyone's really picky about where they want to put their money when we think about all these streaming options. What is Netflix doing that's bringing people back?
Well, they have a few things right now that stand out. One, they had Squid Game that brought back a lot of people. That was really watched more than most shows. And then you have the WWE. I think that has kept people on the service in a way that, other on-demand content can't necessarily, because for the people who watch that, it's live, and it's live every week, and there's a lot of shoulder programming around that. So people who signed on for that or also like that, in addition to their normal content, they're going to stay on that service longer and churn out less. Also, you have children's content, family content, and these are, a portion of the population that will watch the same shows over and over and over, same movies, and you just can't really do without if that's something that your kids want to watch. Beyond that, we've seen over the past couple of years now that just having the advertising tier has reduced churn overall. And you've seen that with such phenomenal subscriber numbers over the past couple of years because it limits churn. You just trade down for a little while when you don't have quite as much to watch. Or if you're price sensitive, that's a great place to go. If you're going to be watching a ton, maybe upgrade back to the premium tier.
I remember when there weren't ads on Netflix, but it's good that people have these options. And clearly we're seeing that to be a benefit for the company here. But how big of a growth driver is the ad tier for them?
Well, right. So this past year, what we saw is that, obviously the introduction of the ad tier and the password sharing crackdown were huge drivers for subscribers and just limiting churn overall. So the subscriber numbers were phenomenal. This year, what we expect to see is, the price increases driving that revenue growth as the ad tier continues to move toward accretion. And I think it's toward close to accretion in the North American market, but it has a ways to go in the other markets. But we'll start to see that as we go into 2026. Where there's just better targeting, at least in the UCAN region, you're going to have really significant targeting, so much more programmatic partners and just options for advertisers that are going to want to be on the Netflix platform. And that should drive accretion and more profitability in 26.
Alicia Reese, thanks for joining us this afternoon. Alicia's Senior Vice President of Equity Research. She covers media and entertainment at Wedbush Securities. A reminder, tune in live to Bloomberg TV and radio. It is our simulcast just after 4 o'clock. When those Netflix earnings are expected to cross. Let's stick with technology, though, because shares of the EV maker Lucid Group rising their most ever intraday after investors learned that Uber is making a $300 million investment in and teaming up with Lucid in the self-driving car startup Nuro to launch a Robotaxi fleet. So Uber said Thursday that it or its third-party partners will purchase and operate Lucid Gravity SUVs that are outfitted with Nuro driver technology on its ride-sharing network. Lucid interim CEO Mark Winterhoff spoke on Bloomberg Surveillance and said he's not worried about the increased demand for vehicles.
We have enough capacity to accommodate both, so we don't think that we will have that problem. I spoke about it right now. We are still in ramping up, and we have some issues to overcome. By the time there are no issues anymore with capacity, I'm very certain about that. So I don't foresee any shortages, and then having to decide, or are we giving it to Uber, or are we giving it to customers? We will be able to satisfy both areas.
Lucid interim CEO Mark Winterhoff speaking on Bloomberg Technology earlier today. Let's bring in Mandeep Singh. He's Bloomberg Intelligence Senior Tech Industry Analyst. He joins us here in the Bloomberg Businessweek studio. When I think of self-driving, I obviously think of Waymo. Uber has partners, though, with many different organizations, including Waymo. What does this partnership actually do for Uber? Is that tech even there?
Well, so what Uber was missing was they didn't have their own AV stack. For a player,
because they sold it.
They sold it. And look, I think there was always that risk that right now Waymo is partnering with Uber in 2 cities, and they're not doing it in the top 5 cities in the US. Austin and Atlanta aren't in the top 5. So it just goes to show that Uber just didn't have the control over AV supply by partnering with Waymo or Pony AI and other players. Now that they have made this minority investment, they have skin in the game in terms of doing this end-to-end with Nuro and Lucid. And look, 20,000 vehicles is a pretty big number, although it's spread out over 6 years. But if you're talking Robotaxis, right now, Waymo's total number of cars are around 1,500. So from that standpoint, 20,000 is substantial, more than 10x. And so in terms of AV share, if AV takes off, I mean, Uber is setting themselves up for a substantial share in AVs. They already have a share of the human rights, But now with 20,000 vehicles, they can say at least we'll be formidable player in AVs.
Well, share returns for investors of Uber are looking pretty healthy, to say the least. We're seeing shares up 50% year to date, and that's against the 15% gain that we're seeing from Lyft. How important is this partnership for Uber and how they match up against competitors, both here domestically and internationally?
I mean, look, what's worked for Uber this year when I compare them to Lyft, which used to be 30% of Uber's market cap, now they are 3% of Uber's market cap. So what's really worked for Lyft is scale. And a lot of people question, why are they expanding in grocery delivery, food delivery? It's not profitable. Scale is the only moat when it comes to online marketplaces. And that's what worked for Uber. That's what they're going after with AVs. Scale, 20,000 AV vehicles. Get that scale.
How does Nuro driver technology work compared to Waymo, for example? Because we know this technology is not all created equal. Look at the challenges that Tesla has had, for example, rolling out its AV tech.
Yeah, so Nuro, so far, the way they have gone about it is they focus more on delivering Domino's Pizza, delivering, groceries from Kroger, and they have a partnership with Walmart. So it may actually help Uber more on the delivery side. And look, there are two ways to go about delivery. You could do drone delivery, or you could do, a vehicle delivery. But with that being said, they have 1 million miles driven to validate their software and their sensor suite. Compare that to Waymo, which now has around 100 million miles. So clearly they're not at the same scale, but Tesla doesn't even have published data around how many miles they have validated. So the number of validated miles is a very important metric. And from that standpoint, you could say Uber didn't have a lot of choice. Nuro is one of the companies that was independent that they could invest in. Everyone else is sort of already either bought or they have folded, like Cruise. I mean, Zoox is another one. They have a partnership.
And that's Amazon.
That's Amazon. Yeah. So there weren't many companies to invest in. And I'm glad they did, because maybe DoorDash would have done something similar, had Uber not come in right now.
Super quickly, Mandeep, in about 30 seconds or less, the company is aiming to launch its first vehicle later in 2026, and that's in an unidentified city. But they do have plans to deploy at least 20,000 of Robotaxis over the next 6 years. Is this ambitious?
No, because we know the scale that Waymo is at. Now they want to get into 10 cities by the end of the year. And I would bet by 2026, with the ramp up that Uber is laying out, Uber and Waymo may be comparable in terms of the fleet size. So I think it's a pretty good number, 20,000.
Mandeep Singh, Bloomberg Intelligence senior editor, senior tech. Excuse me. He does it all. And because it's earnings time, you're going to see a lot more of Mandeep here in the Bloomberg Businessweek studio. Coming up next on Bloomberg Businessweek Daily, the former vice chair for supervision of the Federal Reserve, Randall Quarles, is going to be joining us. He's live with Mike McKee in just a minute. That's next on Bloomberg Businessweek.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got stocks pushing higher. S&P trading at a record 62.99 and change right now, up 35. That is a gain of 0.6%. The Dow also advancing, up 0.6%. NASDAQ Composite Index at a record up 0.8%. And the Russell 2000 Index up now by 1.1%. Economically sensitive shares outperforming after this morning's retail sales and jobless claims data. 10-year 4.45%, the 2-year 3.91%, gold down 0.3%, 33.38 the ounce. West Texas Intermediate crude 67.61 a barrel, up 1.9%, and Bitcoin little changed at $119,777. After earnings, PepsiCo surging 7.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie Pellet. Tim Stenovec and Norah Mulinda in our Bloomberg Businessweek studios in New York. But let's go to Victor, Idaho now, just northwest of Jackson, Wyoming. For more from the Rocky Mountain Economic Summit, that's where Bloomberg News international economics and policy correspondent Mike McKee is joined by former Federal Reserve Governor and Vice Chair for Supervision, Randall Quarles. Mike?
Thank you, Tim, and hello to everyone who wishes they were out here in Victor, Idaho. It's a beautiful day, and we thank Randy Quarles for taking the time to sit down with us. obviously, you run a investment firm now in Salt Lake City and New York. When you're looking at what's been going on in Washington, worry about its credibility?
I'm not fundamentally worried about the institution. I think that the desire of presidential administrations for the Fed to follow accommodative monetary policy is almost universal. The Trump administration is neither unprecedented nor unique in that at all. That's been almost every presidential administration. Mr. Trump goes about it in a somewhat more public way, but the Fed institutionally is very able to process that, in a way that doesn't compromise its independence. So I'm not fundamentally worried about it.
Every Fed person I've ever talked to says politics never enters the conference room when you're making decisions. Scott Bessent, on the other hand, said the other day on Bloomberg Television that what Trump is doing is working the refs, trying to get a favorable decision. Does that have any impact?
Not really. I really don't think so. When I joined the FOMC, I knew the Fed pretty well. I'd been a Treasury official. I'd worked with the Fed in private sector capacities. I thought I knew the institution pretty well, but I'd never obviously been in an FOMC meeting where those monetary policy decisions are being discussed and made. I was very gratified as a citizen to see how absolutely unpolitical the decision-making process was. The discussions are open. They're intelligent. People of different political backgrounds agree with each other. People of the same political background disagree with each other. The politics do not drive the decision-making really at all, which is what you would expect me to say. But I was very pleased as a citizen to see how true that was.
The president has been very personal in his criticisms of Jay Powell. You worked with Jay Powell for years. Is the president off the mark?
I've worked with Jay Powell for a long time. In the first Bush 41 administration, we were Treasury officials together, and Jay is extremely is a much more than capable. He's a rare public servant for this country.
Now, as you look at the state of the economy from the state of Utah, what do you think in terms of rate, the rate level now, and when or if they should be cutting rates?
So I believe that over the course of next year, the economy will evolve in a way that will allow some further loosening of rates. I think that the sort of the fundamentals of the economy support a higher short-term interest rate than we had before the pandemic, than we had in the first Trump administration. Not wildly higher. I think that rate will be entirely consistent with a dynamic and growing economy. And I think that the economy is responding very well right now to monetary policy, which suggests that the policy is not too restrictive at the moment. And given my view that I think that the terminal short-term rate is, likely to be materially higher than the pre-pandemic rate, I don't think that you could, if I were in the room, would I have a view as to whether the Fed should begin cutting in July or September or later in the year? That I don't know, but but I don't believe that they're causing any significant harm to the economy with their current monetary policy.
Randy Quarles, thank you very much for joining us today.
Thank you. Thanks for having me.
All right, there you have it. Michael McKee, Bloomberg News international economics and policy correspondent, standing by with Randy Quarles, the former Federal Reserve governor and vice chair for supervision. They're both down at, or over, I should say, in Victor, Idaho, just northwest of Jackson, Wyoming. It's the Rocky Mountain Economic Summit. It's an event that takes place each year with the top policymakers, Federal Reserve officials, former central bankers, and the like. And of course, it comes just ahead of the meeting next month in Jackson, Wyoming, where we will hear from Fed Chair Jay Powell. Had to cut that interview a little short just due to the wind, but if you missed any of it, you can check it out at Bloomberg.com and, of course, on the Bloomberg terminal. Taking a look at equity markets on this Thursday afternoon, the S&P 500 set to close at a new record. The S&P up 0.6% right now, as is the Dow Jones Industrial Average. The NASDAQ up 0.8% as we speak. Also, keeping an eye on what's happening with Netflix, because we're going to hear from Netflix after the bell. Those numbers typically cross right at 4 o'clock. We'll be doing our simulcast with Bloomberg Television, so be sure to tune in on radio and TV for those numbers as soon as they do cross. Shares of Netflix up 1.7% as we speak. We should note that shares so far this year have been soaring. Expectations are high. Shares up 43% so far this year. And Norah, shares have close to doubled over the last year as a result of optimism around the way that Netflix has just really owned this new space.
Really on a tear, as you've really laid out for us. And of course, we had our previous guest, Alicia, talking a bit about what it looks like heading into this earnings season and how we're actually seeing a lot of churners coming back for Netflix's ad component, that ad tier component for the company. So it seems as though people are coming back for the shows like Squid Games and all these other ones that people would like to tune into. They're willing to pay $1 or $2.
What's your favorite thing to watch on Netflix?
You're putting me on the spot here.
Let's see. I'm making a point here. I'm making a point here. You can't name it, right?
I can't name it.
I think there's this, I don't know if there's this different relationship that people have now with where content comes from than that they used to have. And I think that's a challenge for a lot of people who don't follow the space extremely closely, like analysts.
Right.
Because, for example, you know, if my wife and I want to watch something, my wife will say, okay, I want to watch this. I don't even remember which service it's on. There's not really the association that people have like they used to. With, you know, an HBO, for example, like Sunday nights on HBO when we were growing up. We did speak a little earlier to Wedbush analyst who talked to us a little bit about what to expect in earnings. That's Alicia Reese, Senior Vice President of Equity Research. She covers media and entertainment at Wedbush. She mentioned something that's interesting. This is another quarter, and this is how it's going to work for Netflix moving on. They're not going to be doing the guidance anymore or reporting the number of subscribers they have. That is the thing that moved the company's stock historically.
Right.
So Wedbush did their own research and they found that there's strong retention, that even when there's churn, people are coming back, and people are coming back for the content. And, you know, if you've been following Netflix for a while, you understand that Netflix is a company that for years said, we're never going to do live programming. We're never going to do sports, and we're never going to do advertising.
And we're doing it all.
And they're doing it all
We're
now.
doing it all. I mean, when you look at Wall Street, we have 42 buys on the stock, 18 holds, and only 1 sell. So, I mean, I think that this is really a stock that has proven itself. It's made it very comfortable across the street. Everyone's really behind it. And I think it's going to be really interesting to see what we get from these reports, especially in comparison to all the other streaming outlets that'll be coming out with their metrics as well.
Okay, be sure to tune in. Netflix earnings, 4 o'clock Wall Street time, right here on Bloomberg Businessweek Radio and on Bloomberg Businessweek TV. Year to date, shares for Netflix up 43%, shares up 1.7% on this earnings day. It is Thursday, July 17th. We are just about an hour and 10 minutes away from the close of equity trading. The S&P 500 poised for a record close, up 0.6%. The Nasdaq Composite up 0.8%. The Dow up 0.6% as well. Coming up next on Bloomberg Businessweek Daily, it is stocks that are on the move. Red Brown is going to be here in just a minute. This is Bloomberg.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
It is Bloomberg Businessweek Daily. That is Norah Mulinda in for Carol Massar this afternoon. I'm Tim Stenovec, and we are seeing a lot of green on the screen right now. The S&P 500 set for a new record, up 0.6% right now. The Nasdaq Composite up 0.8%. Nor the Dow up 0.6%. You and I were talking a much different tone than what we saw yesterday.
Risk on day. I mean, we're seeing the Russell up as well. We're seeing green across the board. As you look and dig into the S&P 500, we're looking at 10 out of 11 sectors in the green. The only laggard here is healthcare. We've got Infotech, of course, as the biggest outperformer right now.
Let's take a look at some stocks on the move today. I'm Tim Stenovec along with Norah Mulinda. We're joined by Bloomberg News earnings reporter Red Brown. Red, lot to choose from.
Yeah, it was. You know, lately we haven't been so had such a bounty to pick from, so it's easy for me today. First one I'm looking at is Lucid Group. The ticker on that one is LCID. The big news today, besides that Tim will get to test drive another self-driving car, is that Lucid,
maybe in 2026. I don't know. You tell me.
I mean, with Lucid, there is a lot of question marks around exactly that. Whether or not, in the past they have struggled to actually kind of hit some of their production targets. But this go around, I know you guys are already speaking with the CEO of the company today and saying that they will have the capacity to get these cars out. The news today, obviously, was the $300 million deal that Lucid signed with Uber to launch self-driving cars by next year. So it's another one of these deals that Uber is doing to just kind of flood the market with as many options as they can.
Have either of you been in a self-driving car?
I actually haven't. I don't know how I feel about them, to be honest.
Okay, Red.
I'm afraid. I feel like I've been on the show saying exactly that.
I was once like you too. I was once afraid.
You've been changed, transformed.
I went to San Francisco late last year for an event, and I was with a friend, and she said, "Have you ridden in a Waymo yet?" And I said, "No, I haven't. I don't really want to jump in one of those things." And she was like, "You have to do it. You got to try it." And it was really her endorsement. And she said, when we have friends come and visit, it's like a thing we do in San Francisco. You used to ride the trolley, go to the pier and stuff. Well,
tourist attraction.
Now people get in Waymos. And I did it once. She dropped me off at a place where I could get a Waymo. Mm-hmm. I took it, and like every time I'm there, it's the only thing I take.
But is it cheaper than?
It's like the same price as Uber, or cheaper.
All right.
I compare them.
But I wonder, is it just still going to be like a party trick? But it seems like there's so much money going into it that at this point, like it feels like it will be something we're all doing.
So critics argue that yes, it works in a place like San Francisco because of the mapping that they've done, because of the way the streets are laid out. It's being tested in Los Angeles. It's in Austin, Miami. They're going to do it in DC. They're going to test here in New York. I'm talking about Waymo specifically. I think the big question is whether or not they can pull this off. Waymo or anyone else can pull it off in a city like New York.
Right.
I guess this amount
it
of
doesn't go on the highways in San Francisco. It's just like
streets only.
Yeah,
fair enough.
Well, what else are you looking at, Red?
Another one on my radar is Pepsi. Obviously, they had earnings today. They came out quite strong. The organic growth beat expectations, and this company hasn't had a ton of momentum heading into this report, but now up 7% at the moment. That's the highest since April this year. So they have had some good days so far, but what really caught my attention with this one was actually the reasons why they were doing well. So it's these things like people are getting healthier. They want more protein. They want smaller serving sizes, things like that, which I don't think we always associate with, Pepsi and Coke and things like that. But, it's kind of the momentum right now is behind the healthier options, and companies are, making sure that's available to their consumers.
Poppy. Have you guys tried Poppy?
I was just about to bring that up. I always mix Poppy up with the other one. I'm blanking right now. It's Poppy versus, there's so many different health drinks at this point.
This is a prebiotic or probiotic?
Yeah, probiotic drinks.
Yeah.
And Pepsi's the owner, correct, for Poppy?
I believe so, yeah.
So,
Olipop is the other one.
Thank you.
Yeah.
I appreciate you resolving that.
Have you tried? But that's supposed to be the growth area, right? Pepsi made this big acquisition.
Right. Yeah, I mean, but in that same sort of thematic vein of like, how can we be healthier, right? So that is what consumers have been shouting out for so much. I mean, I will do it after, you want something sweet after like a workout or whatever. It's like, instead of getting a Coke, you get a Poppy, and you don't feel so like you just wasted your last hour.
Makes you feel better about yourself, right?
And that's what's important.
Speaking of health.
Yes, last one on my radar today is actually one of the worst performing stocks that's in the S&P 500. That's Elevance Health. They are down around 12% at the moment. So that's right now trending towards a 4-year, one of the lowest points in 4 years. So that came after the company cut its profit outlook for the year. And this is another theme that we've been tracking through all of the healthcare insurers, is they're just having a really hard time dealing with healthcare costs at the moment. United Healthcare, obviously the biggest name in this space, has been, for me, one of the most important, I think, stock stories of the year, just considering the amount of market cap that company has lost. And we're just seeing it kind of play out through the rest of that industry, through the smaller players as well.
And what's interesting, I saw Vital Knowledge, they put out a note essentially saying that the space has been beaten up, valuations are cheap. So there's not much of a reason for people to buy the dip because fundamentals aren't likely to improve anytime soon.
All right, Bloomberg News earnings reporter Red Brown. For more conversations like this, check out our new Stock Movers podcast. You can subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. All right, we are just about an hour away from the close of trading. stocks not moving from where they were last, up 0.6% on the S&P 500, 0.8 on the NASDAQ and Bos of the Dow, up 0.6%. If you are sticking with us on a Bloomberg Businessweek Daily, we got a great program coming up. We're going to be speaking about the U.S. corporate office profile right now and corporate real estate. We've got an executive from JLL.